Okay, so I'm sorry. Okay, so now the other exception besides the excess liabilities that could be a problem, these services. When you get when one shareholder contributes property, maybe, but another shareholder contributes just their services in exchange for their shares, those services are not the same. It's not eligible for a 351 transfer based on the services. So you still have to make sure that you have 80% control of the people who are transferring assets in order for that to work. So the thing to do is just if you want the 351 transfer without the taxability, you got to make sure that only 20% or less of the shares that are being transferred are relating to services. And then those people that are contributing services actually have a gain because they have to be taxed on that amount of the value that they're getting for their services at the fair market value of the stock. So they would have basis in the new shares to the extent of whatever the fair market value was in those shares, and the corporation would just show it as services provided as compensation. Okay. All right. So now we will, again, we'll work problems related to these, and that's going to clear it up. But this is the sticky part of this chapter, and it's definitely something you have to get your head around. It's not insurmountable. Don't forget me. Okay. Now some other more tolerable topics. Operations on a C corporation compared to an individual, some of the things that are different. There's not going to be any itemized deductions. There's not going to be any QBI deduction, and there's no AGI. So those things are something we know we're used to dealing with, but they just aren't there on the corporate level. And then there's some things that are the same. Net operating losses are pretty much the same the way you calculate how much the net operating loss is. And it's just that net operating losses can only be carried forward, no carrybacks, and they're named carryover. So it would be an NOL carryover rather than a carryback or a carry forward. And then for capital losses, there's a big difference here. You can have a capital loss, but you can't deduct a capital loss. So any capital loss would be automatically just held over until you have a capital gain you can offset with. But the good news is you can't take the bad news was you couldn't take the $3,000 loss each year like we can on individuals. But the good news is you can carry it back 3 years if there is capital gain back there 3 years ago to use. You can't offset ordinary income, but you can offset capital gains up to 3 years past. So you go back to the third year behind you first. If this was a 2022 capital loss, then you could go back to 2019 and try and offset capital gains in that year. If you didn't have any capital gains, then you'd go to 2020 and see if there's any capital gains there. You could use your loss to offset them if there are. And then if there's still none there, you can go to 2021 and offset any capital gains in that year until you get to the point where you use them up. So then if you still haven't offset all your capital losses, then you would wind up carrying them forward to your next year. And as soon as you have capital gains, you can offset them with your carryover capital losses, but you can't offset other income. So that's just one difference for corporations. Then charitable contributions. There's a limit of 10% of taxable income that you can take for charitables. And so what you do is you take your taxable income before you deduct charitable contributions or dividends received deductions or capital loss carrybacks. And you say, what is the taxable income? Well, 1/10 of it is the most that your that your charitable contributions can be. And so if you have extra of charitable contributions, you just take those forward up to 5 years. You can deduct cash contributions just like normal, plus capital gain property at its fair market value, plus ordinary income property at its basis, which is the same rules that we had for individuals based on how do you tell what's capital gain property and the ordinary income property. It's done exactly like we did it in individuals, but it's just you got that 10% of taxable income limitation as well, right? Okay, now for the dividends received deduction. This is a compensation that corporations are given because they are getting dividends from another corporation that was not deductible to that other corporation, as we talked about the double taxation thing. But for corporations, they get a benefit that's somewhat better sometimes than the qualified dividend status where they get a favorable return rate. This one is actual deduction that the corporation can take if they got dividends from another corporation. So the amount of deduction they get depends on what percentage of ownership they have in that other corporation. So I have provided previous years amounts of the deduction. You'll see these up through for 2017 and back. And it's not that I'm thinking we're still in 2017. It's just that sometimes you need to know what the dividends received deduction was back in a previous year. And so I just noted them so that you would know it changed. And so in 2017 and earlier, if you had less than 20% ownership, you could deduct 70% of those dividends as a deduction. But now, if you have 20% or less, you can only deduct 50% from 2018 forward. So that's just a change that happened right there at that 2017, 2018 timeframe. And then if you own 20% or up to 80%, not quite 80%, but from 20% up to 80%, used to, you could deduct 80% of those dividends and not show them as taxable, but now it is at 65% for 2018 and forward. And then if you own 80% or more of a corporation, you can deduct 100% of the dividends received deduction in all the years, the early years and the current years. So a dividends received deduction is based on modified taxable income. The taxable income before you deduct this dividends received deduction we're talking about, and before NOLs, before capital losses. And so a dividends received deduction limitation does not apply if there's an NOL that was about to happen. So in those cases, you would get to full deduction of the amount that's allowed for that ownership level. So that is also another complicated topic that's in this chapter, and we'll practice some exercises related to that also in another video. All right, so now organizational costs and startup costs. We've already talked about these in the individual taxation classes, but this one is just revamping it and talking about it from the corporate level because there's more organizational costs normally in relating to corporations. And so organizational costs would be the cost of organizing, like the fees to the lawyers to set up the corporation, to prepare the documents for the articles of incorporation and file with the Secretary of State and that sort of thing. And so those are organizational costs. Whereas there's the other kind of costs that are similar but not the same, and that is the startup costs. These are the pre-productive costs that are going to be your normal ordinary expenses, but they can't be deducted yet because you're not actually producing income yet. And so those would be like the initial rent that you had on your building, the market surveys, and maybe the setup costs for your offices, that sort of thing. A lot of things that would be ordinary expenses normally and on an ongoing basis, but they can't be deducted yet because it's pre-production time. There's no income coming in yet. And so those startup costs and those organizational costs are both subject to the same limitations, but they're two different sets of costs. So you use the same rules to decide how much to deduct, but they're not the same and you don't pool them together at all. Okay, so these separate pools, if they're less than $5,000 cost in either of the pools, then you can deduct it all currently. If it's more than $55,000 total of either of those two pools, then you would just amortize it over a 180-month period, starting on the 1 month that you actually had the cost. And then if it's somewhere between is where it gets a little sticky. Okay, so if your costs were between $50,000, between $5,000 and $50,000, then you could deduct that $5,000 up front, and then the rest of the cost you would amortize over the 180 months, which is 15 years. All right, if you're at this strange little window of cost between $50,000 and $55,000, then you would lose dollar for dollar anything as far as quick deductibility, the first year deduction. You would lose some of that $5,000 fast costing to dollar for dollar for each total organizational cost or total state startup cost that exceeded $50,000. So that it sounds complicated, but it very seldom actually applies. And when it does, it's pretty straightforward. If you're over 50,000 cost, but you're still under 55, it means some of your costs might still be deductible just directly in that first year. whatever's left of your $5,000 that's between 50,000 and 55, whatever's left that you didn't exceed the 50,000, then you can take that as a first year write-off. And then the rest of whatever's left is going to be still spread over that 180 months, starting in the month it was put in service. Okay, we'll probably do an example about that one too. And then business interest limitation. This is a significant effect on corporations usually, because they sometimes actually do have a large business interest factor, but it can't be more than 30% of their taxable income. There's some examples in the textbook you can look at to see that. And then talking about compliance for the corporation. This is the easy part. The flat rate's 21%, as I mentioned. For corporations, they file Form 1120. And then there's these schedules that go with the form, and they basically just reconcile the book income to the tax income. And so those schedule M1 and M3, they're called the M adjustments, Schedule M adjustments, just line out the difference between the tax and the book rules. So you'll see it starts with net income per book, and it lists the differences between the two. The left side is showing the things that are unfavorable, which increase taxable income because there are unfavorable differences between what the book will let you allow, let you deduct, and what the tax return will. Mostly is that. And so it increases taxable income. Everything on the left side of the M1 or M3, and then everything on the right side decreases taxable income because it's things that are allowed as expenses or not shown as income for tax purposes when they were included the opposite way for the income, the financial statement. So you end up with a taxable income number before the NOL and the dividends received deduction. And so you can reconcile what was the difference between book and tax. So if you're looking at deferred taxes and the calculations that you do for deferred taxes on your financial statements, those are the same type of expenses that are going to show up in your M1, M2, and M3 adjustments. Okay, and so then we're not going to actually dig deep into that, but I would like for you to understand what those are. There's a really good example in the textbook where they show here's some differences between book and tax, and here's how they fall on the M1. Which I think is very good for you to trace that through, because that's something that trips a lot of preparers that aren't comfortable with corporations very much, and it's really nothing to it. Once you understand book, you understand financial statement reporting about deferred income tax, and you understand tax rules, it's going to be a piece of cake to get that thing to reconcile between the two. Because in order to do your financial statements, you have to take into account these differences between book and tax. And then that's the same ones that have to be accounted for in order to do your Schedule M calculations. All right, so the tax returns for corporations are due 3.5 months after the year ends, which is April 15th. There's extension available for up to 6 months after that. Well, actually, it's an automatic 6 months. If you ask for an extension, you get 6 months extension. You don't have to wait that long. You could file it earlier, but you get that automatically, but not without asking for it. You have to file a Form 7004 to ask for an extension in order to get it. It's automatic once you ask, but just it's not that you don't have to file anything. It means you have to tell them it's going to be late. Okay, it is an extension to file, but not an extension to pay. So that means you still need to pay whatever balance you think you're going to owe. Estimated tax payments require the corporation to pay in advance a balance they think they'll owe if they have a balance of $500 or greater. And it's based on the amount that you pay as estimate is the way to avoid penalties for underpayment. And so there's two things you could use. You could use the 100% of the previous year's tax if any amount of tax was owed. The exception would be a corporation that has more than $1 million taxable cannot use that previous year's safe harbor based on last year's tax. But most corporations can because they don't have this kind of taxable income. But 100% of previous year or 100% of the current year. So if you know you don't meet the qualification because your taxable is too high, or if you didn't owe any tax last year, you'll have to estimate this year's tax and pay that much in order to avoid penalties. Estimates should be made at the lowest amount that is avoidable, that avoids that penalty, because they don't pay you any extra for paying any more. If you're going to get a refund on your corporate return, they're not going to include interest unless it's way past the due date for the return, because they're not obligated to do so. So why would they? And then there's 4 estimate dates of when you pay your estimated tax payments. And they're in the 4th month, 6th month, 9th month, and 12th month. So if it's a corporation that's on a calendar year, that would be April 15th, it would be June 15th, September 15th, and December 15th. That is slightly different from the individual due dates because the last estimate for individuals is due in January the following year. Okay, so I think that's all that I have for now on this. We'll work some problems and that will clear up some of this. Okay.